Well, for more insight and analysis into this latest Fed move, let's bring in William Cohan. He's a special correspondent for Vanity Fair and the author of Why Wall Street Matters. Thank you for joining us.
Hi, Rachelle.
So it didn't seem like there were any surprises in the Fed rates decision, but what about how they reached the decision?
Look, I applaud the Fed for doing what it believes is right by focusing on the data. You know, the job of the Fed, according to a famous former Fed chairman, James Mackenzie Martin, was to take the punch bowl away as the party's getting started. And that's the job of the Fed. Most Fed chairmen don't do that, but Chairman Powell seems to be sticking to his guns and is willing to see the economy being strong and raising rates accordingly to make sure things don't get too out of hand.
And Fed Chair Powell did say that the economy's health did warrant this rate hike, and it was a unanimous decision. So talk about some of the data points that warranted this rate hike, not just domestically, but potentially globally.
Well, look, you know, the U.S. economy has finally sort of broken through the doldrums that it was in for many years, sort of stuck between 2.25% and 2.5% GDP growth. You know, in the third quarter of this year, GDP growth was more like 3.5%, thanks to probably the big tax cut that occurred at the beginning of the year, where corporate tax rates were reduced from 35% to 21%. Some economists think that that's been sort of like a sugar high for the economy, and I think Fed Chairman Jerome Powell was sort of alluding to that in his remarks, where he talked about how both world economies and the U.S. economy was going to slow down. I think it's really important to note that between 2008 and 2016, the Fed was on this quantitative easing binge, which artificially went into the market, bought up all sorts of bonds, drove up the demand for bonds, decreased the yields on bonds, and sort of artificially lowered interest rates to levels not seen in generations. And I think it's really important that the Fed step back from that and begin to normalize interest rates, let the market work the price of money, let the market work supply and demand when it comes to money. And I really applaud Jerome Powell for letting that process happen, even though, yes, it's going to cause people to pay more for mortgages and car loans, and even high-yielding debt instruments we're going to yield more than they had in the past, and that is all healthy for the credit markets.
So then, as the Fed does continue to raise rates, how prepared is the U.S. economy to deal with a projected slowdown next year, and by some assessments, a recession by the end of 2020?
You know, look, the truth is, you know, nobody knows when the recession is going to hit. Nobody knows when the economy is going to slow. You know, I think a mistake, it would have been a mistake for the Fed to cave into the political pressure from the White House and keep rates artificially low. Again, money is like any other commodity. It needs to respond to the pressures of supply and demand. And for 8 years during quantitative easing, interest rates were kept artificially low. People were mispricing risk left and right. That's why you're seeing this slowdown in the high-yield issuance market. There hasn't been a new high-yield bond issued this whole December so far. Leveraged loan market is backing up. You need to let the market work and let interest rates rise to the level of a proportionate level of risk that's being undertaken. And I think with Jerome Powell not being shy about raising rates, you're going to see that return to normalcy in the credit markets, and that is essential. People need to be rewarded for the risks they're taking, and they weren't being rewarded during the 8 years from 2008 to 2016.
And then looking at the U.S. markets, we saw that they didn't rally on the news, but rather continued their downward trend. And with this now softening tone in terms of the pace of rate hikes in 2019, what can investors expect?
You know, look, believe it or not, I think that the market just overreacts to these things. They expect one thing to happen. They expected Jerome Powell to side with President Trump and to cave into this political pressure. And then when he doesn't, when he does the right thing, the market freaks out. So the market will get through this. A correction is healthy. You know, don't forget, the market has gone up almost something like 30–40% in the last 2 years. So this is all very healthy. It's more important for the long best running, the best functioning of the economy for the interest rate market, for the credit markets to be returned to normalcy. And I applaud Jerome Powell for making a step in that direction today.
All right, thank you so much for your insights. William Cohan there, author of the bestseller Why Wall Street Matters and special correspondent for Vanity Fair.